The Tom Woods Show, episode 2092.
Prepare to set fire to the index card of allowable opinion. Your daily dose of liberty education starts here. The Tom Woods Show.
Folks, if you're like me, when you criticize the Federal Reserve, you get all these lackey-style responses. Why, the Fed has made the economy more stable. You don't want to go back to the 19th century, do you? All kinds of arguments like that. Well, you can blow those and others out of the water with my free ebook, Our Enemy, the Fed. Grab it at ourenemythefed.com. Hey folks, Tom Woods here. Well, everybody's talking about price inflation these days, so I thought, why not get our old friend Gene Epstein back on here to share his thoughts on the subject about where we're headed and what's going on and what, if anything, we can do about it to protect ourselves. Gene, you will remember, of course, as having had quite a storied career. He has been economics and book review editor at Barron's. He's worked at the New York Stock Exchange as chief economist. He's got many, many, many credentials. And of course, he is the director of the great and heroic Soho Forum, which hosts debates of interest to libertarians and really to all people. And he's just an all-around great guy. So I'm glad to welcome him back. Gene, glad to have you back on the show.
Tom, it's great to be back on your show and to acknowledge and thank you for all the support you've been giving the Soho Forum. As I've said to you a couple of times, more than 2 or 3 times, you lift my mood. Your show lifts my mood. And a week or so ago, my mood was especially lifted when you had Dave Smith on the show. And the first 10 minutes of your interview with Dave Smith, you're spending half the time talking about me and the Soho Forum and repeating once again that you give me a pass for my sinful behavior, the awful sin of hosting events in New York City where the vax requirements have been imposed. And I'm grateful to you both for that position. Dave even, of course, outdid you for flamboyance. About a month ago, he said on his show that you should not patronize any place that imposes vax requirements unless it's hosted by Gene Epstein's Soho Forum. So,
well, let me say, before people who don't know you yet lose their minds.
Yes. Thanks.
You bent over backwards to help people out in this terrible situation by literally opening your own home to all these straggler libertarians, you don't know who they are, coming into your house so that they could watch the event on your gigantic screen and have some fellowship. And that was a wonderful thing for you to do. I'm glad that all these restrictions have been scrapped. Yeah. I haven't been to New York City it was 2 years ago this month that you and I had the fateful last meal together.
Our last lunch.
Last lunch. And so I decided, what the heck? I have a few people I'd like to visit, you among them. So I'm going to take a little visit up there next month and we'll resume at the same restaurant where we ended 2 years ago.
That's right. It wouldn't have been such an important lunch had it not been on March 9th, about 3 days before all the lockdowns were imposed, and so that's what made it such an unforgettable lunch, just what happened shortly after that lunch. But my sin definitely was, and I thank you for acknowledging that, I opened my home to folks who didn't want to be vaxxed or masked. And I actually had Robbie the Fire Bernstein do a warm-up act for those particular people because Rob was also not vaxxed. But look, it still was, let's say, a misdemeanor. I still was willing to put up with the requirements for the vaccine. An incident that really just always bothers me a bit is that when I had the Scott Horton, Bill Kristol debate uptown, there was somebody lined up who had a vax card that had 13 days on it. And because it wasn't 14 days, they didn't let this guy in. I mean, the irony, of course, is that I knew a lot of people were submitting false papers and getting in, and this guy couldn't get in. And Scott was there and he wanted to talk to the management. I love Scott Horton. He apparently thought if you just talk to the management, you'd get them to be more reasonable. Anyway, so some awful things happen, really stupid things happen. And when my chief assistant was very upset about what we were doing, look, a lot of people said, look, take your show and go to Florida, take your show on the road. Why are you staying in New York? So, of course, you cut me some slack Tom, by saying, look, he's probably been living in New York virtually all his life. Indeed, Tom, I've been living in Manhattan since 1967, which I believe is before even Old Woods was born. And so it is a little bit of a habit to be here. I did take the show on the road to Florida and elsewhere, but I just was getting a little tired and I wanted to have these debates. Look, partly, I guess, Dave has been inclined to give me a pass because I was able to have that great show with Bill Kristol versus Scott Horton, one of the best debates we ever had. But I still thank you for all your generosity about this. And indeed, as you say, things are looking up in New York City. Mayor Eric Adams is not hardly my ideal libertarian mayor, but he's a heck of a lot better than Mayor Bill de Blasio, who was before him. And early this month, he officially lifted the vax requirements. To my dismay, the April 11th debate was going to be held at a venue that was still going to impose the vax requirements. So I quickly switched it to the Sheen Center at 18 Bleecker Street that has responded to the mayor's decree, no vax requirements, no mask requirements. So come one, come all, I no longer have to make my home available to the unvaxxed and unmasked, although on April 11th, doors open at 6 o'clock at the Sheen. The event starts at 6:30. There will be a reception in my home this time around as well. My home is only 2 blocks uptown from the Sheen Center. So I want to take this opportunity to talk to all of you unforgiving out-of-towners. Despite the fact that Tom and Dave give me a pass, I did sin. I do apologize. Let me make it up to you. We're going to throw a big event on April 11th, and it's going to be a debate between Brookings Institution fellow William Galston and former State Department official Peter Van Buren. Those of you who listen regularly to Scott Horton's show will be familiar with Peter Van Buren. He's been on Scott's show several times just over the past year. He's an outstanding guy. I think that William Galston will be a worthy opponent. They are going to debate the issue of China. Galston will defend the resolution the U.S. should use its military power to deter China from invading Taiwan. Peter Van Buren will take the negative. And on top of that, I'm reinstituting the warm-up act. I will have Robbie the Fire Bernstein now at the main venue. He's going to be the warm-up act. He can come because there are no vax requirements. So that's going to be at the Sheen Center, Monday, April 11th. TheSoulForum.org is where you can find the tickets that are on sale. So thank you, Tom, for allowing me to make that announcement.
Well, my pleasure. I hope people will check that and all your events out. Now let's get to our topic for today, which is price inflation, which has made a return and does not appear to be transitory in what will now go down as the immortal word of Jerome Powell at the Fed.
Yes.
So, Gene, let's first start off with, look, a lot of Austrians have been predicting price inflation for a long time.
Yeah.
And for some reason, they got it right this time. What's different about this time? Anything?
Indeed. There's a lot different that sort of grabs you by the lapels if you follow the official numbers the way I do. First, I want to say that you might want to shut this recording off, you people out there, and listen first to episode 2016 of the Tom Woods Show. It was called The Truth About Inflation, a relatively recent episode in December that you did as a solo, Tom. You sort of set the stage and made it unnecessary for me to belabor a few points that money expansion is at the root of price inflation. At that point, you were keying off Elizabeth Warren's statement that greed was at the root of this price inflation. And you explained in great and simple detail that money expansion has got to be the root of it. Well, one of my hobby horses about greed, before I get to your question, Tom, one of my hobby horses about greed is that I like to say, look, if you want to accuse all businessmen of being greedy, okay. I mean, a lot of them really are in it because they love the product they sell, and that the money is a byproduct, and that was true with the biggest nut of all, Steve Jobs. I mean, he just loved to bring out these products. The money was just the means of bringing out these products. But if you want to say they are just greedy, put a fine point and recognize that they are greedy for profits. And the reason why I want to emphasize profits is because so many of the great fortunes were made not from raising prices, but by lowering prices. Sam Walton comes to mind, basically Jeff Bezos, and indeed also Steve Jobs. So indeed, greed doesn't necessarily motivate a rise in prices. It can often motivate a cut in prices because that's how you sell to the masses. And that's very common. So I have an obsession about correcting that point. But let me get to your question, Tom, more precisely and say that I don't need to key off Elizabeth Warren's crazy statement the way you did when you spoke about inflation in December. But it would be, I think, noteworthy for me to key off what the guy you just mentioned, Federal Reserve Chairman Jerome Powell, said in his statement yesterday about the inflation. It's a couple of sentences, so let me read it. I have it written out printed in my notes. He said, "Why have inflation forecasts been so far off? In my view, an important part of the explanation is that forecasters widely underestimated the severity and persistence of supply-side frictions, which, when combined with strong demand, especially for durable goods, produced surprisingly high inflation," unquote. Well, notice that in that statement, and indeed in no part of the statement he made yesterday does he mention Milton Friedman's insight that price inflation is always and everywhere a monetary phenomenon. And nowhere did he mention facts and data that sort of stare you in the face, grab you by the lapels. Let me mention two bits of data that I track because I spent 25 years at Barron's writing a column on the economy in which I was supposed to interpret the data. As a matter of fact, the column was called Economic Beat, but at one point they were going to call it Behind the Numbers. The St. Louis Fed keeps numbers on what they call federal debt held by Federal Reserve banks. Federal debt held by Federal Reserve banks. Because when Federal Reserve banks hold debt, they have to acquire it. And when they acquire this debt, they buy it. And when they buy this debt, they buy it with money that the Fed creates. So money creation is at the source of this federal debt. And the St. Louis Fed data, which goes through the fourth quarter of 2021, fourth quarter, just the year that ended, shows over the last 2 years, an increase to $6.1 trillion in debt held by the Federal Reserve banks from $2.6 trillion just 2 years before. That's more than a doubling in the amount of debt held. It's a jump of $3.5 trillion of debt held. And the second greatest 2-year increase was through 2011 when they acquired an extra $1.7 trillion. Just from 2 years ending fourth quarter 2011, the acquisition was an extra $1.7 trillion, but over the most recent 2 years, it was $3.5 trillion. More than double what happened then. And bear in mind that interesting about the numbers is that they acquired $3.5 trillion more, but debt always matures. Debt always disappears. So in order to increase the amount of debt held, they had to buy more than $3.5 trillion in order to make up for the fact that a lot of debt that they were holding matures and therefore disappears. So again, that number, which is off the charts historically, should tell you something about the possibility that inflation was going to take off. Or it should tell you something about at least explaining it in retrospect, but it's something that Chairman Powell neglected to mention. The next bit of data is the more conventional measure, what is known as M2. M2 is a measure that goes back many years. It's got, from my perspective, as somebody who covers the numbers, when you have something that has a long history, then it's of great value. You can compare it with the past. Well, similarly, over the last 24 months through January 2020, the M2, now, I'm sorry, before I get to M2, let me define it. M2 includes M1, which is cash and checks, but it also includes near monies, which are savings accounts, money market, small bank CDs. When you think about it intuitively, we hold cash and checks, but we also hold money in a savings account, potentially money in a money market account, near money that we actually do think of it being money that we could use to purchase things with. So it's a reasonable definition of money, M2, very standard, blessed by the monetarists, and certainly kept regularly by Chairman Powell's own Federal Reserve Board. Well, there was a 41% jump in M2 over the 24 months ending in January 2022, a 41% jump, which amounted to an extra $6.3 trillion in M2 increase. Now, again, because we have data going back to 1960, we can compare that with the past. That 41% jump in strict percentage terms is off the charts. The most recent 24-month period in the current century was an increase of 18.9%, or 1.7 trillion. In other words, we have a 41% increase now, and the most recent one was 18.9%. The previous peak was back in the 1970s. In the high inflation 1970s, we had increases of 27 and 28% in different periods. So now we have an increase in M2 of 41%. So again, it's kind of a no-brainer to think that maybe that has something to do with the increase in price inflation. And to anticipate one question you might have about why yours and my esteemed colleague Bob Murphy was predicting price inflation and he missed it, was that at the period when he was predicting it, these figures for the acquisition of debt by the Federal Reserve banks and figures for the increase of M2 were far milder, far tamer than they have been over the last 2 years. So that's sort of like the first chapter in what I want to account for, Tom. Maybe you want to comment and step in. Well, any comments from you, Tom?
Well, of course, we know the Milton Friedman statement about inflation being always and everywhere a monetary phenomenon, but some people have come back against that under the current circumstances, saying, well, surely all the disruption on the supply side going on, this may be one of those rare cases where a shrink in supply may be driving prices as much as anything else. So how do you respond to that?
All right. I guess I haven't convinced you, I guess. But actually, there is a nuance involved here. But let me just say one thing, that anybody who says that, and that's of course Jerome Powell. I mean, put it this way. Powell talked about that, the severity and persistence of supply side frictions. Don't you think that if you're Chairman Powell, and if your own organization generates these numbers, and if Milton Friedman's insight is fairly well known, that you at least want to confront the data that I just cited? M2 increase has been off the charts over the last 2 years. The acquisition of federal debt has been off the charts over the last 2 years. So doesn't empirically, and off the charts again, it's historical data. It's compared to the past. We've seen nothing like it over the past half century in terms of acquisition of money, the classic viewpoint, which is that the Federal Reserve banks acquire debt, and that money is then spent and it goes out into the system. It seeps into M2. We have both of those, the acquisition of debt and the increase in M2, off the charts historically. And we're playing the game of anybody who just looks at the numbers and analyzes them. And now we're going to say, no, it wasn't that.
Yeah, okay. But on the other hand, Gene, couldn't you have said that following the downturn of 2008, they engaged in just extraordinary interventions that may not be quite as much as they've done since then, but we were saying those were off the charts historically, and yet they did not lead to much price inflation.
Well, as a matter of fact, the M2 increase, I only want to say, I guess, correct my colleague Bob, that the M2 was not off the charts. The biggest M2 increase was 18%, 18.9% to put at that time in 2012. It was lower. I looked for the biggest one since 2008, and we're now looking at 41%, more than double that amount. Of course, it's far, far more in absolute terms. It's more than double in absolute terms. No, excuse me. It's an increase of 6.3 trillion versus 1.7 trillion. So it wasn't off the charts. But so we can at least say with the benefit of hindsight that it wasn't off the charts. But beyond that, I guess I want to grant something. You're actually forcing me to anticipate something. What I am saying, and in this way, I guess I'm maybe it's the point to emphasize, because it's the one point I'm going to try to introduce that's different from what you hear from many of my Austrian colleagues, different from what you have said, Tom, is that there is an interaction between the actual supply and demand side of the market, between the actual fundamentals of the marketplace and the way the Federal Reserve acts. Actually, the way I want to emphasize that point because it's most relevant to what I think is going to happen going forward. But I do believe that there's something empirically important about the fact that the price inflation that occurred in the 1970s started from a very tight labor market. And that when Bob and others were predicting an increase in price inflation that would continue, we were looking at a very loose labor market. And the dynamic is maybe a little bit hard to describe, but maybe you could think of it this way, which is something I learned by covering the markets for a long time and talking to money market economists who look closely at what the Fed does. So much of the dynamic of what goes on with bank lending is that the banks issue lines of credit to their bank-dependent institutions. Many businesses, of course, that are very representative of the economy. They might be smaller businesses, but they do business with larger corporations, so they have to borrow. That money is borrowed, and then the Federal Reserve looks at how many commitments have been made for lines of credit. Those are checking accounts, lines of credit. And then the Federal Reserve underwrites that by expanding the money supply in accordance with it to make it possible to happen. I think that's what happened in the 70s. And in a tight labor market, when wages are rising, because of the tight labor market, there is greater pressure to borrow more, greater pressure to have more money in the system. And that's what I believe is a key reason why we might be looking at that dynamic going forward. So therefore, I don't deny that the supply side effects might have been part of the reason why that M2 figure exploded. The one thing I do think has to be noted, however, is that what was also off the charts over the last year and was not nearly as great in the period following 08, 09, and 10 is the acquisition of debt by the Federal Reserve. In other words, the Federal Reserve banks in general, the Federal Reserve mainly, were acquiring debt like there was no tomorrow. And so the standard idea that the Federal Reserve buys up all this debt, a huge jump in the amount of debt held, and then over the last 2 years, 3.5 trillion, and then that money goes into the system. That's a great deal of what did happen, and that's the reason why I believe it's more important than the supply side pressures that were put on the Fed, which meant that they were accommodating the need for more money in the system. So I don't know if I've made that point clear. I'm only saying that the twin pillars of my point are that it's not just the M2 expansion, but it's really the clear initiative on the part of the Fed to buy up more debt. That's what's unusual about what happened in the last 2 years, and that's what did not happen in 08 or 09. So that's why I believe that it is a kind of a push me, pull you. That when you spoke, Tom, on your show in December about the wage price spiral, I wanted to say to you that you're absolutely right, except up to a point. In a regime run by a Federal Reserve that has the capacity to increase the money supply, there is a strong tendency, I shouldn't even say tendency, there is a strong habit to accommodate a wage price spiral. No wage price spiral can get off the ground if there were not a Fed that increases the money supply, that is there to increase the money supply. But what I'm trying to emphasize is that oftentimes the dynamic by which money is expanded in the textbooks and oftentimes repeated by Austrians always assumes that the initiative comes from the Fed. It doesn't recognize that the initiative can come from the private sector and that the private sector then induces the Fed to underwrite all of the debt that's on the books and expand the money supply accordingly. So therefore, I'm granting a part of some truth to the supply side pressures over the past couple of years, but I'm also emphasizing that the enormous initiative to purchase all this debt, which is going to be a big problem later on because that debt is not going to stop expanding, the federal debt is not going to stop expanding, is also a key part of what's been going on. Does that make any sense to you at all?
Okay, that's fair enough. Before we go any further, I have a couple of kind of entry-level questions that I know are on people's minds that I want to make sure we cover. You're talking about the labor market, and all of us in our experience as consumers keep observing the following situation. We go into some establishment and we get an apology that I'm so sorry, we're short-staffed, it's impossible to find help these days. Just be patient with us, we're doing the best we can. Why is it impossible suddenly to find help? Where did all these people go? There's no more free money being given out. What is happening here?
The labor force participation rate, you do have to age adjust it a bit. And so it's definitely about 1 million or so lower than it was before the lockdowns started, before the Great Depression started. So you are asking, where are these 1 million or 2 million people hiding? How are they getting by? Well, I guess they've got some savings, Tom. They have been coming back. I mean, certainly. But the difficult thing, you asked the hardest question of all, Tom. When we talk about the labor force participation rate of prime age men, 25 to 54, what it was 96, 97% in the 50s. And then in the late 60s, it started to decline. It's now down to 88%. And then, 88%, which means, 1 out of 8 prime age men doesn't have a job, whereas it used to be 1 out of 25. And so where are all these guys? Are they really all house husbands, taking care of the kids? Well, the answer is very few of them are, but it's difficult to know how they get by. Are people working a bit off the books here and there? I think that's true too. And so my best answer to the question is that they didn't necessarily spend all their money and they're still getting by and reluctant to come back into the marketplace. I know that's an inadequate answer, but on top of that, of course, I should add, they probably are picking up a few jobs here and there. And I should add as well, as I mentioned, that the population is getting older and it looks as though the people over 65 have decided to stay with their early retirement decisions they reached in 2000. They can get by, they can afford it. So that's my inadequate answer to that question. But to put a finer point on the question you put to me, Tom, the tight labor market is indeed partly measured by the data that the Bureau of Labor Statistics has been producing since the year 2000, which is the number of available jobs. The number of available jobs is now 1.7 jobs for every unemployed person, and that was also off the charts. It was usually fewer than 1. Now it's 1.7. So, and that's, over the last 22 years, it's a record high and off the charts. So that's part of the reason why we've got a tight labor market. So we know we have a tight labor market, and I've just given you a very inadequate conjecture about what all those people are doing. They're obviously not starving. At least we know that.
Well, an easier question for you, but covering a topic that I think people need explained, involves when you casually say that the Federal Reserve acquired debt and they go out and buy this debt. I think people need explained what that means. Like, as bring it down 5 notches. What does that mean? Because it doesn't sound like something a person would do. I wouldn't go out and quote, buy debt. Debt is a bad thing. Like, they don't understand. A lot of people don't understand. What does this mean? The Federal Reserve buys debt.
When I said buy debt, I guess it is put badly. You might invest in bonds, Tom. That's not a bad thing to do. I mean, necessarily. It's a bad thing maybe to go into debt, to incur debt. But the Federal Reserve is buying debt, just like you and I might buy debt. We might buy debt because we want to diversify our portfolio in some bonds that pay a rate of return. So that's why we might buy debt, you and I. But getting to what the Federal Reserve does, it has been actively in the business of what in the textbooks they call open market operations. It buys from bond dealers. It buys debt on a regular basis from bond dealers. And it establishes funds of the banking accounts of these bond dealers when it purchases the debt. You hand the bonds over to the Federal Reserve, and the Federal Reserve puts in your bank account its own money, and that goes into the banks. So that means then that money is created, put into the hands of the banks in order to acquire that debt. The one thing that's actually changed over the last, since 08 or 09 or prior to that, is that the Federal Reserve used to target only the short-term interest rate, what's called the Fed funds rate, the overnight interbank rate. But what is known as QE, quantitative easing, is a euphemism for the fact that the Federal Reserve started to acquire debt all along what's called the yield curve, started to buy mortgage debt, started to buy longer-term debt, and buy it, again, by saying to the dealers, we want to buy, what do you got in terms of notes, or 10-year notes, 12-year bonds, and we'll put money in your bank account if you'll just hand it over. What's the price? So it was bidding up this debt, and when you bid up the price of a bond, I shouldn't call it debt anymore. I should just call it bonds. These are bonds. They are treasury bonds, and they are mortgage bonds as well, a private sector mortgage bond. So when you bid up their price by becoming a key part of the demand for this debt, then since the debt pays a fixed amount of money in return, then the difference between that fixed amount of money and the higher price you're going to pay means a lower interest rate. So the whole point of the policy was to bid up the price of the debt so that the interest rates on these bonds could fall. And that's what the intent of the Fed has been. It's expanded its purchases again, not just to targeting the near-term interest rate, but to targeting interest rates all along the yield curve. It's gotten more ambitious in the process. Now, the pressure on the Fed to buy debt is felt because it wants to keep interest rates down. But then what's happening at the other end? The Treasury is issuing more and more debt in order to finance its operations. And when you're selling more and more debt, that selling pressure pushes the price of that debt down. And that means that you may have to borrow at a higher and higher interest rate. I hope I've explained that. The Treasury is selling debt, actively selling $1 trillion, $2 trillion worth of debt that it's got to sell in order to finance its operations. But then the interest rate is rising because of that selling pressure, because in order to sell that debt, you might have to accept lower prices for it. So the Fed steps in and buys a lot of that debt and keeps the price up and therefore keeps the interest rate down. So the dynamic between the fiscal needs of the Treasury and the actions of the Fed operate hand in glove. And that's, I think, a big reason why the Federal Reserve banks have acquired so much of this debt over the last 2 years. But of course, by doing that, they're inflating the money supply. Hopefully that was okay, Tom, or do you want to?
No, that was okay. That was okay. So now I want to go from there and ask you to explain why you said in your past few emails to me that you are anticipating that this level of price inflation could persist for quite some time.
Yeah.
What is it about the current circumstances that makes you say something like that?
Well, we are, I believe, in part, repeating the 1970s. To some degree, it's a bit different. To some degree, it's even worse. As I've said, the 1970s price inflation began with a tight labor market. And then it eventually rose to what was called stagflation, where the unemployment rate rose, and yet the inflation persisted. And so that's what I'm struck by. I don't want to be necessarily looking backward by too much, but I do want to say that there are parallels. But a couple of key differences are differences that make matters worse. The ironic part of it is that Powell's recent speech, especially yesterday, showed that he sounds like an inflation hawk, that if you compare what he is saying now with what Federal Reserve Chairman was saying in the 70s when price inflation took off, it sounds as though he's much more concerned about price inflation than Federal Reserve Chairman were in the mid to early 70s. But one of the key differences is that he's maintaining a short-term interest rate target that's known as the Fed funds target that's so far below the rate of price inflation as to be just ridiculous. That's something else that stares you in the face. Here's another historical chart that I can briefly describe, don't have to show it, which is to compare the interest rate that was targeted by the Federal Reserve since 1970 to the present. 1970, which is during the inflationary period when we hit more than double-digit inflation, to the present, up till this week. Compare that with any measure of price inflation you might want to use. I used in one particular case the 12-month rate of price inflation based upon the preferred measure of the Fed, which is the Personal Consumption Expenditures Price Index. And you find something that somewhat even surprised me, which is that in the period from 1970 to 2000, the target of the Federal Reserve was always higher than that measure of price inflation. In other words, you always had a short-term interest rate that was higher than the measure of price inflation, even in the 1970s when price inflation was running close to 10%. Even then, it was with very rare lapses, it was higher. Going into 2010, it began to fluctuate in relation to price inflation. Since 2010, we're looking at a targeted rate that's almost always below the rate of price inflation. And now Federal Reserve Chairman Powell is up there talking about how much he's worried about price inflation. He's looking at a price inflation rate of 6.1%, and he's maintaining an interest rate of less than 0.5% of 1%. And he's determined, by all accounts, to raise that interest rate to 3%. In other words, to make sure that it's going to stay well below the recent rate of price inflation. Somebody might have asked him, if you're so hawkish on inflation, why are you not being a little bit more aggressive about the interest rate? And why have you been engaged in such a radical departure from the policies of the past. You again emphasize that I'm trying to keep my narrative conventional. I'm trying to look at historical data that we have consistent data and trying to just compare it with what's been going on in the past. Why, Chairman Powell, or when you had Federal Reserve Chairman that for 30 years and then even into 2010 maintained a Fed funds rate above the rate of inflation, you maintained it below, and now you can continue to maintain it below the rate of price inflation. So again, that's my first long-winded response to the question, why am I especially concerned now that the forces that ignite price inflation are at work? Because he's maintaining an interest rate that's below the rate of price inflation, and you'd think it's kind of a no-brainer. And I'm really sticking to sort of conventional Chicago-style economics when I talk in these terms, nothing very Austrian or radical, which is that in a rational market, you want an interest rate that's higher than the rate of price inflation. And that, certainly, Tom, if you and I are going to lend money to somebody and we expect the rate of price inflation to be 6%, 7%, or 5%, or 4%, we want whatever that expectation is, we'd be far more comfortable if we could lend at an interest rate that's above the rate of price inflation so that we could get some real rate of return. It's a very conventional notion to talk about real inflation-adjusted interest rates. So Powell is continuing this policy. Perhaps you know that over the past 10 years, the idea that you had to maintain this ridiculously low interest rate target of near 0% was because they wanted to goose up the rate of price inflation. You spoke about that at some length, Tom, in your own talk about inflation in this past December, about how important it is to maintain some positive rate of price inflation. But even imagining that they had to do that, why is Powell not acknowledging that there's been a dreadful mistake? Now, again, if he were honest, he would acknowledge it's been a dreadful mistake. We have an interest rate that's way below the level of price inflation, and that is a huge departure from the policies of the past half century under the regime of the Federal Reserve. So that's my concern, which is that we basically have a Fed chairman who is not even acknowledging the huge purchase, as I've tried to explain, of bonds by the Fed as a key factor, the explosion in M2, and the fact that his targeted interest rate, and indeed all the interest rates along the yield curve, 2%, are below what seems to be the expected rate of price inflation. So that's my first key concern. But again, I'm going into all kinds of stuff here, so I want to make sure you step in, Tom, and try to modify what I said, simplify it, or tell me how I'm getting too obscure. Any comments from you, Tom?
No, I don't think that's the case here.
Okay.
And plus, what people need to know more than anything is that Powell is going to stick with what he's been doing. And so what that means is that if what Gene is telling you is right, then you need to think about what your strategies are going to be to hang on to your purchasing power.
Well, right. But he's moved. Tom, it's odd when you have these little twinges when you realize, wouldn't it be such a more pleasant world? You understand how people get pushed out of their comfort zone when they're told that Chairman Powell is just not really reliably running the show. When they're told that Biden is not reliably running the show, they get pushed out of their comfort level. And so I remember just yesterday I read Powell's speech and I thought, that's nice. He's actually concerned about inflation. He's moving in the right direction, so there's something nice about that. So he's going to do what he's going to do. He does say he's concerned, so that's a little bit reassuring. I'm only saying it falls way short of what you would expect if he truly were concerned about price inflation. He would acknowledge the key points that I've made if he really were concerned, if he truly could be trusted to handle the situation. But now you anticipate, of course, the next part of it, Tom, which is what can you do to protect yourself, for which I'm going to have somewhat inadequate answers. But I wanted to finish my other main pillar of what I want to stress, which is the difference between what was going on in the 70s and what's going on now and what will be going on over the next 10 years, which, of course, I've already emphasized. The U.S. Treasury has an insatiable demand for debt. This is a concern that's constantly expressed by the Congressional Budget Office, a Keynesian-oriented, nonpartisan organization, the Congressional Budget Office. They point out that the debt is unsustainable, that the deficits are unsustainable, that $1 trillion deficits are becoming the norm, and that sooner or later, there are going to be real problems down the road. They project that if you look historically at the average interest rate that was paid to finance the U.S. debt, the U.S. Treasury debt, it was a little under 6%. And now the cost of financing the debt is about 2%, a little under 2%. And partly, I guess, because of complacency on the part of bond traders, partly because of efforts by the Fed to keep the interest rate down. The Congressional Budget Office projects that we could get up to 4.4% on the average interest rate, still well below the historical rate, that the historical average that the Treasury has paid. But if we get up to 4.4%, and if we look at the addition to the debt that's in prospect over the next 10 years, then we're looking at a real crowding out of the federal budget just to finance the debt, just to pay for the debt. So that's a real concern 10 years from now. It could be a concern even sooner than that. And so that's why I'm especially concerned about the prospects for inflation, because Powell is going to have pressure on him. It will be pressure perhaps just politically imposed, but it could also be pressure just practically imposed in order to keep interest rates down, to keep acquiring Treasury debt, to keep acquiring more debt than ever. So that's another key factor. That, by the way, was mentioned by Alan Greenspan in a book he wrote called The Age of Turbulence. He projected this as a problem in 2030. He thought that the Federal Reserve Chairman there has got to be especially vigilant because of the pressure to finance the debt. Well, it's happening a lot sooner than that. And so 10 years sooner than that. And so that's the other factor that's new in the landscape and new that Powell is not acknowledging, and that will be pressure on him. The very thing that happened over the last 2 years, the acquisition of $3.5 trillion more in U.S. debt, could continue given the pressure to keep the financing costs of the U.S. Treasury within reasonable and manageable limits. So that's the other factor. But I want to go back to the dynamic that I stressed before, which is that there is such a thing as a wage price spiral when you are talking about the existence of the Federal Reserve. That so much of the time, the dynamic really is that there is more need for money, there's more need to pay labor, there's more need to raise prices in order to earn profits. And that means that there's pressure on the banks that the Fed underwrites to lend more, to open up new lines of credit, and for the Fed to underwrite that. And I believe that's a dynamic that especially took hold in the 1970s, starting from a tight labor market. By the way, when Bob Murphy was predicting, and others in the Austrian School predicting an increase in price inflation, I grabbed an insight out of the seat of my pants and I said, look, in the 1970s, it started with a tight labor market. I'm a little skeptical that the dynamic is going to build because at this point, we're looking at a very loose labor market, a very high unemployment rate as we were in 08 and 09 and 10. And so that's why I was a little skeptical that it was going to take off. So those, I guess, are the three main sort of pillars of my argument that we are facing up and down. It may not be 6.1% over the next year. If you look at the 1970s, it jumped around, but it gradually built toward 10%. And then in the 1970s, we had Paul Volcker. We had Paul Volcker who came along and recognized that in order to stop the expectation, the wage price spiral, the Federal Reserve has got to stop accommodating all this demand for more money, which, by the way, they talked about that in the Weimar Republic hyperinflation in the 20s, that there was a need for more and more money in order for business to make a go of it because the inflation dynamic had taken hold. And so Paul Volcker hiked the federal funds rate, the target rate, to 22%. He let it go to 22%, but in effect, he really did hike it to that 22%. When we're looking at the same interest rate is now less than 0.5%. He hiked it to 22%. He knew that would bring about a recession. It did indeed in 81, 82, bring about the worst recessions at that point since the Great Depression. The unemployment rate was about as high as it was in 08 and 9. That was over 10%. And then that did set in motion disinflationary forces. And by the way, Volcker did have the courage to do that. And it was, unfortunately, a necessary thing to do, because you might say that 10 to 12% price inflation is something the economy could live with, but the dynamic is for it to continue to accelerate. And 10 years later, we could have been at 100%. That would have been possible. So that's why what Volcker did was necessary. And in fact, again, I emphasize that there are real forces in the world that put less pressure on the Fed to create money. And those real forces did take place in the 90s. The opening up of the world to cheap labor put less pressure on inflation, less pressure on the Fed to create money. So that's why, again, in a way, the new point I'm trying to introduce is that there is a dynamic between the real economy and the Federal Reserve. That dynamic would not exist if there were not a Federal Reserve. If there were gold or Bitcoin as money, that dynamic would not exist. But the supply side and demand side dynamics on the Fed, pressures on the Fed, actually are a factor and will be a factor going forward in the next 10 years, and were a factor in the inflation story of the last 50 years.
Hey, folks, let me take a minute to tell you about a fast-growing podcast in our circles, CounterFlow with Buck Johnson. I know Buck Johnson. He's a great guy. Many of you know him as well. I trust him completely. He's sound on everything, and he's a seasoned veteran in the Liberty Movement. He played drums for Jimmy Vaughn at several big Ron Paul events in 2008 and 2012. Now he is the humble host of the CounterFlow podcast. It features long-form interviews with dissenting voices, always flowing counter to the typical mainstream regime talking points. He's explored lockdown insanity with Dr. Jay Bhattacharya, the radical new right with Representative Anthony Sabatini, paleo-libertarianism with Jeff Deist, and a lot more. Always digestible, always concise, always relevant. And you know the sound quality is top-notch, as he and I both use the same producer. So whether you're a longtime libertarian, a traditional conservative, or someone just now waking up to the insanity of the modern left, check out the CounterFlow podcast with Buck Johnson, dropping every Tuesday on YouTube and all podcatchers. For more info and all of Buck's links, visit counterflowpodcast.com. That's counterflowpodcast.com. So in terms of what the average person can do, I suppose you could manage to figure out some stock that's going to beat the market, but that's no foolproof approach. A simple thing that Joanne Skousen recommended in a session that I did with her and her husband, somebody asked, if I'm supposed to keep a 6-month emergency fund in cash, which is what you hear commonly recommended, how do I prevent that 6-month emergency fund from being eroded by inflation? And she said, well, one way is by putting that cash into real goods that you know you're going to need, like food. Why not stock up on food now rather than later? And you could even, think about, this might be a little tricky for somebody living in Manhattan, Gene, but you could think about finding a farmer or a farm, a community-supported agriculture, where you can buy basically like a part of a cow and then just get all the meat and then just hold on to it for as long as you need it before it goes bad. And that's a way of doing it. But as a matter of fact, let me plug something that an earlier guest, a couple hundred or so episodes ago, was promoting. That's a website called farmmatch.com, and it matches you up with farms in your area who are ready to sell directly to you, the consumer. And sometimes there is beef available. So there are ways that you can do this with local resources you might not even be aware of. But what other, there was this article in Bloomberg, maybe you saw it on Twitter, everybody was mocking it, about how to cope with inflation. And they're saying things like, take the bus, and instead of eating meat, eat lentils. And then they also said, and you may have seen my response to this, they said, don't buy in bulk. But if you expect the inflation to continue, of course you buy in bulk.
Well, Tom, just a moment. First of all, because you're dealing with a guest, Tom, who, as I say, you put me in a good mood, so I turn on your show. So I'm a regular listener, Tom. And you did go over this, the idea of buying meat. By the way, ironically, I met a guy named Austin Padgett, who happens to be, I don't think he minds getting famous, although I don't want the competition to take my business away with Austin Padgett.
I know Austin.
From me. You know Austin, exactly.
Of course.
Okay. Austin is the significant other of Angela McCardle, so that's why I met him. And incredibly charming guy. And he had me spellbound, telling me all that he knows about farming. And he had me very, salivating when he talked about Padgett Farms. I don't know if you've heard about that. So I made a deal with Padgett Farms to buy their incredibly great cuts of meat, Tom, even though I'm a city dweller. And so I've done that. But Tom, when I heard you talk about this with Jeff Herbener, and Jeff said he was doing it, immediately a little data problem struck me. And why I think that if you're going to do it for my reason, which is that you might just like the meat, it might be the best cuts that go to restaurants so you can get it too. If you happen to be a carnivore such as myself, that might be a good reason to do it. But the problem with the idea of thinking that buying meat or any kind of food in advance is an inflation hedge is that even in high inflation times, food jumps around in price. It jumps around in price such that it actually declines. It actually plummets even during periods of price inflation. And just to verify that, I looked up numbers in the early 1970s. In December 75, the meat component of the consumer price index was up by 17.4%. But by the end of the next year, in 1976, it had plummeted by nearly 12%. So you have to be pretty agile if you follow my math there. In other words, it's not just that the meat price is volatile in terms of rising, it's volatile, even inflationary time, to the point of actually declining, and declining by more than, in this particular case, nearly 12%. In other periods, something similar happened, although not as extreme. So the problem then is that you might catch the wrong part of that cycle. If you paid a lot, if you bought all your meat in 75 and then buy meat going into 76, you were unable to take advantage of all the collapse in prices that occurred in 76. You follow my point then? In other words, if you follow the CPI, you know that the two most volatile components are energy and food. So that's why the alarm bells began to go off when I heard about this meat thing. And I looked up the meat index and I found that indeed, in the worst of the inflation, when it was going nearly 10%, the meat price could collapse in a single year. So you would have been better off buying in the year to come and not buying in bulk. You see my argument there, Tom?
I do. So, but I think, first of all, this goes to show how complicated this all is for the average person.
Yes.
Right?
Indeed.
It goes to show what the fiat money system does. So now it's not bad enough that the average person, just to maintain his purchasing power, winds up in the stock market without necessarily having the requisite knowledge or trying this and that. But now he's got to speculate on which kinds of food are more likely to go up and down in price.
Tom, that's the food component. It really is true. This what they call the core CPI. I always say, if you really want proof that economists have a tin ear, then understand this thing they call the core consumer price index. What could be more core than buying food and energy? But they call it the core consumer price index that excludes food and energy. It's really the underlying trend in the CPI excludes food and energy because food and energy bounce around up and down. And so if you have that trend CPI, then you find it's a much more stable trend to give you an idea of what the direction in the consumer price index is. But my only point, again, my usual garrulous way of explaining, that food and energy really do bounce around. They can go up and they can come down even in inflationary times. But so therefore, I wouldn't do that. But Tom, let me cut to the chase and get to my very tentative picks and say a couple of obvious things. The first is that I'm invested a fair amount in real estate investment trusts. That's also not without risk. It's not without some danger, but there, of course, I'm not talking about jumping in and out. See, inherently, when you buy food, you're jumping in and out of the market every year because you got to buy more bulk, a year later. And so in that case, you may be caught in a chainsaw. So you're not really getting ahead of inflation by doing that. But if you buy and hold and a real estate investment trust, which might not necessarily go up and might go down a little bit over the next year, if you hold it for the long term, if you expect price inflation to be heating up, then if they are reliably run commercial home real estate investment trusts, then you have a good chance of having an investment that stays ahead of inflation. Because again, obviously, that's what does tend to rise during an inflation. There are badly run real estate investment trusts. I don't want to necessarily mention the ones I've invested in, but certainly, at least that's something that you could constructively think about. If you're just a hapless investor, you might want to buy a fund that invests in a fund of funds, that invests in different real estate investment trusts to diversify that way because you don't trust your expertise about that. So that's one potentially constructive suggestion I would have, which at least makes a certain amount of robust So you presumably you could repeat that recommendation, Tom, or do you have doubts about it that you might express?
No. That's fine. It's just.
Yeah.
But again, it goes to show that this is not an easy thing for the average person, because I don't know anything about that kind of investment. I would have to go learn it. Well, the old-fashioned way that you could protect yourself was when you had monetized gold and silver coins.
Yeah.
They would just increase in value, or they would hold their value. So this wasn't an issue for people.
Well, no, it's troubling. I believe that, you could get reasonable advice about real estate investment trusts. It's not impossible, but you're right. It's not that easy. But okay, you mentioned gold, and of course you haven't mentioned Bitcoin. And gold, certainly in the 70s, did prove to be a good inflation hedge, assuming you knew to get out once Volcker, I don't know if you would have known this with the benefit of foresight, but probably would have recognized that a 22% Fed funds rate was probably breaking the back of the inflation, and then you would have gotten out of gold at the right time, because gold then it soared to the stratosphere from $40 an ounce, $50 an ounce to $800, and then it collapsed back down to $200. So that would have been problematic. But I do recommend considering gold and Bitcoin, even though gold and Bitcoin's behavior over the last inflationary year has been somewhat erratic. But certainly over the last 2 years, Bitcoin has been up. And logically, if you're not looking, again, I emphasize that none of what I'm talking about is something you should think about in terms of a 1 or 2 year investment. It's got to be at least a 5 to 6 to 7 year long-term holding, possibly even longer than 6 to 7 years. And so I dare say that gold and Bitcoin over the next 6 to 7 to 10 years are going to stay ahead of price inflation. And I think that, again, I'm not suggesting that if you have any kind of large portfolio or that you put a whole lot of money into those assets, but I do believe that they should be a part of your portfolio. But then getting now to the broader issue, well, let me stop. What is your reaction to the idea of gold and Bitcoin, Tom? Do you have any strong opinion?
Well, the way I think about it is you have to be prepared that you might be making a mistake.
Yeah.
In the sense that gold went through a very bearish period, and maybe that was the period in which you held it. And Bitcoin seems to go through shorter bearish periods. But again, if you're looking to park your money somewhere temporarily and then get it back in a year, you could lose a third of it,
Tom. Absolutely. Look, again, you had an interesting guy. Again, I'm a faithful fan. You had an interesting guy on who was talking about chasing this idea of somehow using the Wall Street business cycle theory to invest, being able to play the cycles. And I say good luck with that. And then to this guy, good luck with that. I'm somewhat dubious about how easily that can be done. To some degree, that's what Mark Skousen does try to do. I think he's had some success. I observe a lot of people who use models to try to play the cycles, all very difficult. So indeed, I emphasize again, nothing that I can talk about is for the next year or for the next 2 years. It's only that, oddly enough, I'm presuming to make a forecast about the next 10 years, because even though I'm not sure what's going to happen over the next year, next 2 years, it's like just as much as I'm sure that I'm not going to live forever, I believe, so I'm making a long-term forecast that way. I believe that there are basic fundamentals in the marketplace with the Federal Reserve, with the Treasury, that are going to cause price inflation to heat up compared to the last 20 years. So gold, as you know, the behavior of the gold price certainly is fairly well explained by the behavior of price inflation, Tom. Certainly, the gold price basically gave up and went into a bear market once price inflation fell, once the disinflationary period began, and when we got back to 2%. I believe that it's not difficult to explain why it happened. There were huge supply side, real disinflationary forces that took place in the economy, in the global economy. The end of the Cold War, which cut the military budget, the opening up of markets to cheap labor, all of those things that are now seemingly coming to an end, they're explicable. The gold price responded and the gold price fell. So therefore, again, I'm looking at, I would prefer to say the next 10 years at least in terms of what you might do. I'm not talking about whether it's going to be good for the next year or so. And indeed, you talk about the Bitcoin price falling or the Bitcoin price collapses. I'm talking about, the old income averaging kind of thing, $1,000 a month of gold, $1,000 a month of Bitcoin, where you're diversifying over time. And if the price is lower, you buy more of it. If the price is higher, you buy less of it because you're buying the same $1,000 worth. So you're accumulating a position in it that way. And hopefully, it's not like you're sinking everything you own into the Bitcoin or the REITs or the real estate investment trust or into the gold. But I do want to mention one final point, which is that while I believe that the stock market is not going to deliver over the next 30 years the way it has over the previous 30, I believe that if you look at the period since 1970 or since 1950, then the stock market is probably not going to perform nearly as well as it has. And when I talk about performing well, I mean the following. I mean that at a minimum, if you take any 15-year period in the stock market and you include, in all fairness, although, of course, you can't always manage it this way, you can manage it only if you have a retirement account. In all fairness, you reinvest all dividends. Then you hold the stock market, reinvest all dividends. There's never been a 15-year period, and actually this goes back to 1870, in fact, but I'm now just going back to 1970 for the moment. Never been a 15-year period when the stock market did not give you a positive rate of return, inflation adjusted. The stock market has kept ahead of inflation at any 15-year period since 1970 and any 15-year period since 1870. And so while I believe that it's not going to perform as well for reasons that I mentioned because of the instability caused by the risk that the Treasury is going to have difficulty, that there could be a kind of a fiscal crisis caused by the Treasury. That will certainly hurt the market and certainly hurt the economy. That's going to be a phase that we're going to have to go through. But I'm saying that if you are willing to buy and hold for 15, 20 years, if you're young enough, you certainly are young enough, Tom, at 49, put money into the market and think about looking at it when you're 70 years old, it probably will have stayed ahead of price inflation. But again, this is none of what I'm saying negates the Austrian business cycle theory. Austrians know what's going to happen. The problem with time is with timing. We don't know whether it's going to happen this year, next year, 3 years from now, 4 years from now. The market is simply not cooperative when it comes to knowing how to time it. And I leave that to people far smarter than myself. So that's my summary, Tom. Any response to the Epstein portfolio?
Well, all I'll say is I'm always very interested to hear everybody's portfolio and what they consider important, what they've looked into. I know people who are exclusively in Bitcoin or some crypto.
Oh, yeah.
Exclusively. And I could see that could turn out to be a really, really excellent long-run play.
Yeah.
But, you do have some short-term needs in the meanwhile. So I like to divide my stuff around. But actually, for me, I know you didn't ask me this, but I've got some gold and silver. I've definitely got some Bitcoin.
Yeah.
I got in late, but in the sense of it was $550 a Bitcoin when I got in. So that kind of late.
Oh, wow.
So
that's pretty...
So like when it dips to 40,000, I don't say, "Oh, what a disaster,"
That's good, Tom. Yeah, it dipped from over 60,000 to 40,000, and Tom, you didn't curse the heavens and say, "Damn it, I lost 1/3 of my portfolio." You looked on the bright side, right, Tom? Well, that's very mature of you.
Well, because the way I think is, I'm still up 80 times.
Yeah, exactly.
So you got to be happy with what you get. And then I do have, obviously I have some cash, and I do have some money in the stock market where I follow Mark Skousen's advice, and I don't do every single thing that he recommends, but I do some of it. And so overall, I'm pretty happy with, and a little bit of real estate too. So it's, but you know what, Gene, my real strategy, we'll wrap up with this. My real strategy for the future is not so much putting money somewhere and expecting it to increase, although that would be great. It's more basically working until I drop dead. Because I have a job that's not going to kill me. I could do this for a long time. I could hit 10,000 episodes, Gene. You never know.
Yeah.
I could do this for a long time. So I'm just going to keep doing it because I enjoy doing it.
Yes.
And then in the course of doing it, I build up various income streams that are, that if one of them dies off, that's okay because I have 8 others. And so I like that I've got that so that no matter what happens with the stock market, I still have this thing that I made that I sell, people are still buying it. And I have this affiliate thing with Audible and people still join Audible through my link. So I still get that. And so that's another way of doing it. It's just building up a number of alternative ways of generating some smackers.
Well, that's quite right, Tom. And yeah, indeed, actually, you anticipate my final words, which are similar to yours. Not everybody, folks, can be as talented as Tom Woods and can like what he does as much as Tom Woods does. But really, most of us just want to have jobs that give us a reasonable sense of purpose, a reasonable sense of supporting our family, of working with people we like at a minimum, and recognize that your real way of dealing with what's to come with the price of inflation is just what you would normally do anyway, which is try to find something to do with your career that you enjoy doing. In my particular, at the age of 77, I could get by doing little or nothing, but I like what I do. I like having a sense of purpose. So I pretty much continue what I'm doing. I'm still doing articles, doing interviews with Tom, running my Soul Forum. And so find something that you'd probably like to do in your 70s. But of course, obviously, your real focus should just be narrowly that, as Tom said, that maybe he'll run out of energy and maybe I will. And so we'll need some kind of nest egg to live on. And so that should be your main focus. And that's the reason why that's oriented toward the kind of time horizon I'm talking to, assuming that many of you out there are even younger than Tom, younger than old Woods, who's 49, or even younger than 59, then you're still working. And your only plan is, well, what kind of nest egg do you want to have 20 years from now? And that's the reason why most of what I've suggested, if you have a 10 and 20-year time horizon, having a nest egg just in case you're unable to work, that's what I've suggested is oriented toward. And that's what Tom has pretty much been talking about. So again, to try to summarize my catalyst suggestion, try to find something that you like doing that earns you a reasonable income, that pays most of the bills, and that gives you a little bit of savings for your retirement. And that's the best way to cope with the inflation to come.
All right. So with that, we're going to wrap it up, and we're going to remind people that Gene is running the Great and Heroic Soho Forum. So many great debates. You can listen to them on their podcast. You can attend them in person, which is really what we ought to be doing after years of weird isolation. So check out thesohoforum.org. And as always, Gene, my thanks. So would you have a final word?
Let me again emphasize, Tom, because of that sin. No vax requirements at the next Soho Forum on April 11th. So please, wherever you are, please come to town. I'd love to see you. Thanks again, Tom.
Excellent. Okay. Thank you, Gene.
Bye-bye.
All right, folks, that's going to do it for today. Tomorrow, our old friend Carla Gericke, President Emeritus of the Free State Project up in New Hampshire, joins us. We're going to catch up on what's going on up there. And if you are not somebody moving to New Hampshire, at the very least, maybe you can try to model what they're doing up there, because they've got some interesting developments that are, I think, worth trying to replicate in other places around America. So that's for tomorrow. Thanks for listening, everybody.
Become a smarter libertarian in just 30 minutes a day. Visit TomWoods.com to subscribe to the show for free, and we'll see you next time.
Like the sound of The Tom Woods Show? My audio production is provided by Podsworth Media. Check them out at podsworth.com.